The global financial crisis of 2008 sent New Zealand into turmoil. However, as we're on a strong path of recovery, we at Kentigern College have decided to keep the LCR rate at 2.5%. Our decision is made according to the Policy Targets Agreement, whereby the CPI inflation should be kept between 1 to 3% over the medium term. Now currently, CPI inflation is currently at 0.9%, which is below the target band. However, in the midterm, we can see it is currently projected to increase well within to the 1 to 3% band, and therefore we believe it is best to keep the LCR the same at 2.5%. There are three overall factors that drive New Zealand's inflation: international trade, domestic upside pressures, and the domestic downside pressures. International trade, i.e. the Chinese market, the US market and the Eurozone, continues to be shaky. Domestic upside pressures, i.e. low mortgage rates, Christchurch rebuild, increasing business and consumer confidence, rising oil prices, continue to grow, and these have the greatest impact on inflation in New Zealand. Current downside pressures, i.e. negative tradables inflation, high unemployment, the large output gap and fiscal policy tightening are weakening, leading to an overall strong, projected upward inflation momentum. An examination of international trade shows stable to lowering inflationary pressures. The US economy has shown improvement, but it has recently been stagnating given 7 to 9% unemployment and contractionary fiscal policy to curb high debt. This is giving rise to concerns that the US may fall back into recession, and we at Kentigern College believe this could possibly be a deflationary pressure for New Zealand, as this could dry up our exports and therefore dry up our aggregate demand. Chinese growth has also decreased from 2010, and being the most critical factor and trading partner to New Zealand in the midterm, it may decrease our exports and our export demands. However, the easing of Chinese monetary policy and increase in Chinese discretionary incomes may offset this and increase our dairy exports. Also, many European countries have implemented a fiscal contraction, and although this was intended to reduce their government budget deficit and improve their debt to GDP ratio, their debt has worsened as GDP has contracted so much. Now we believe this is a great area of uncertainty. However, we do not know if Greece is going to leave the Eurozone. We don't know if the Eurozone will break up. And if they do, this could mean a great decrease in our aggregate demand. But along with this, we see that the great turbulence in the Eurozone increases international interest rates, which are passed on to us and increase our domestic interest rates. So, along with a global downturn impacting our exports, this turbulence in the global markets meant that when the Reserve Bank attempted to boost our economy by drastically reducing the LCR from 8.25% to 2.5% after the 2008 GFC, the floating and 2-year mortgage rates did not have an equal decrease in the interest rates, leading to a 3.5% gap as shown here. Now this was due to the extra perceived risk in the markets, for example from the Eurozone and from the global turbulence. So, any attempts to promote growth and inflation by lowering the LCR are unlikely to be successful, as commercial interest rates will not decrease proportionately while global turbulence still exists. Now, although mortgage rates did not decrease as much as the LCR, mortgage rates were still historically low, and this has caused the housing market in New Zealand to drastically grow, which brings us to the upside inflationary risks in the New Zealand economy. These consist of historically low mortgage rates, the housing market boom and Christchurch rebuild, increasing oil prices, and business and consumer confidence. Now firstly, after the LCR drop of 2008, mortgage rates were at historic lows of 5.5%. This greatly incentivizes consumers to purchase new homes, which increases our AD. This will continue to be the major driver of inflationary pressures in the midterm. Auckland has led the increase with a 13% rise in house prices, with a 7.5% increase in Christchurch and around 3% throughout the rest of New Zealand. In Auckland, the increase is due to rising demand meeting a restricted supply, with an annual increase in housing consents of 4,000 being significantly less than required for the growing population. Also, the government has projected to spend over $4 billion by 2013 on rebuilding in Christchurch, and coupled with the construction costs increasing from Canterbury, having increased from 1 to 10% since 2010, the housing market is providing a significant demand pull inflationary pressure. Now, the growth in the housing market has also contributed to a consistent increase in consumer confidence since January 2012, which is mostly likely due to the wealth effect, as consumers see their houses are getting more valuable and they increase their spending. Now, with business confidence also drastically increasing over the last 12 months, we expect investment and consumption to greatly increase, increasing AD and inflationary pressures. Now, crude oil prices have also been increasing significantly lately, creating cost push on headline inflation. However, at the Reserve Bank, we do not take this into account for our core CPI inflation, as this is headline inflation, which is not involved in the core CPI. However, we see this increase in the oil prices could actually affect the way that it affects the core CPI. Because this increase in oil prices could increase the prices of manufactured products, but also because the oil has such an inelastic demand and consumers have to purchase the same amount of oil, the discretionary incomes decrease, which could decrease aggregate demand in the economy, and so we are unsure as to how this oil price will affect our economy. The growing demand in our economy, behind the strongest of these inflationary pressures, has allowed New Zealand to grow since the 2008 GFC. Further, we expect that the deflationary pressures which were previously offsetting this demand pull inflation are going to diminish and transform into inflationary pressures in the midterm, and therefore inflation will fall into the target band and this growth will continue. These deflationary pressures consist of a high TWI, low tradables inflation, high unemployment, a large upward gap, and the fiscal tightening in the latest budget. Now, over the last 12 months, New Zealand has appreciated against some major trading partners, as shown by increasing TWI. This is because, although we're facing a global downturn, there is still great demand for our agricultural products. However, in the projected midterm, the TWI exports will now become relatively more expensive, decreasing our exports, increasing our imports, and causing our TWI to start decreasing due to the lack of demand in New Zealand dollar. This is reflected in our low tradable inflation, currently at negative 1.1%, projected to drastically increase due to exports becoming priced more competitively, increasing aggregate demand, and meaning this deflationary pressure will transform into an inflationary pressure in the midterm. Secondly, unemployment figures have risen significantly from 3.5% in March 2008 to 7.3% in March 2013, but are projected to drop by 5% to 2016. Now, along with the weakening wage pressures projected on the producers, the output gap is also projected to close, with capacity utilization projected to increase to 91.5%. And this output gap closing means we are approaching potential output, and therefore any increases in the aggregate demand to 83 will bring inflation into the 1 to 3% band. Now, this is due to previously we were not operating near potential output, but as the output gap is closing, we are approaching this part of the curve on the aggregate supply, and therefore an increasing aggregate demand will cause a less than proportionate increase in growth, but will increase the inflation, which is desirable, and this is why the OCR should be kept the same, and why it will increase into the 1 to 3% band in the midterm. The very final deflationary pressure is from the fiscal tightening in the 2013 budget, which will lead to restrained growth in the midterm as the government seeks an operating surplus by 2015. Now, this fiscal tightening decreases AD and reduces inflationary pressures on the economy. Also, the future budget surplus will act as an automatic stabilizer by withdrawing money from the economy, which will increase national savings. However, as this will lower interest rates, this will increase consumption in AD, meaning this too is predicted to increase into an inflationary pressure in the future. So as we can see, there are many deflationary pressures turning into inflationary pressures in the midterm. The inflation rate definitely will enter the target band between 1 to 3%. However, this does pose the risk for the inflation rate exceeding the band above 1 to 3% in the midterm, which means Reserve Bank may need to increase the OCR in the next year or two. Now, if this is needed and if this happens, the OCR will be effective as there are large household debts and the majority of mortgages are short-term. The historically low mortgage interest rates are greatly increasing investment in real estate, and this means that household debt levels are at an all-time high of around 145% of disposable income. Therefore, if the Reserve Bank increases OCR, we would immediately and directly decrease disposable income in households and decrease consumption and investment to keep that grip on inflation. Also, in comparison to previous years, there has been a significant change from fixed-rate mortgages to floating-rate mortgages, which will aid any increase in the interest rates to have an immediate impact on household balance sheets. So, if inflation does exceed the projections, the raising the OCR can effectively and quickly control inflation in the future. In conclusion, the major inflationary pressures to our economy is a strong demand pull that comes from our low mortgage rates, developing housing market, rebuilding in Christchurch, and increasing confidence. This increasing demand in our economy has allowed strong growth since the 2008 GFC, and as the main deflationary pressures of the output gap, high TWI, negative tradables inflation, high unemployment and tightening fiscal policy are expected to transform into inflationary pressures, our strong demand will continue to cause growth as we approach potential GDP, pulling our inflation from 0.9% into the 1.3% band in the midterm, and therefore we believe it is best to keep the LCR at 2.5%. Thank you.
Thank you. Right, so I'll start off with the questions. So as you noted, at the moment inflation is currently below the bottom of the target band. Does the cause of low inflation matter? For example, it could be a fall in oil prices against, say, a general drop in aggregate demand. That's just an example, but the question is, does the cause of low inflation matter? And would your policy response be affected by that?
Low inflation can happen from a decrease in demand. Low inflation could happen because of a decrease in aggregate demand or a supply side increase. Yeah. And so if it's a decrease in aggregate demand, we need to lower the interest rates. But if it's a decrease in increase in supply side policies, we might have to think about it differently.
Yeah, because of something like the Auckland housing market, you can't put up the
house.
Speak up.
Yeah, sorry. So it does depend to an extent on the type of...
If it's headline inflation, like oil prices or food prices, there's not a lot the Reserve Bank can do because that's the nature of it. But if it's core, like stuff like investment and changing, the Reserve Bank can address it. So I think that if the Reserve Bank can only address core inflationary risks, they can't address the inflationary risks.
Yeah. Okay, so basically we believe that there's several causes that can happen to a low inflation rate. It could be either a low aggregate demand or a difference in the supply side of the economy, and therefore we believe if there is a decrease in the aggregate demand, we will need to lower the interest rates to increase the aggregate demand in the economy, and so therefore it does matter on our policies what the reason is for low inflation.
Okay, thank you. The Reserve Bank has a target of inflation of 1 to 3%. Why is that the target?
Well, obviously, we don't want inflation to be too low because we don't want to fall into a deflationary spiral.
Risk, yeah.
And also, we don't want it to be too high.
Because we don't want
inflation.
wage
spiral as well. Yeah.
So all the problems associated with inflation.
Talk about it, guys.
We want to some growth in the economy. Yeah. Do you want to summarise it?
Do you want to summarise it?
So basically we believe there's several aspects to keeping it 1 to 3%. There's us wanting to keep it positive and not negative, and keeping it above zero. So basically there's many risks involved in having a high inflation rate, involving it being bad for business confidence and being able to project for the future. We believe it's bad for savers. We believe it's bad for people on fixed wages and other reasons, and it could also cause an inflationary spiral. So that's why we don't want it to be above 3%. And we definitely don't want inflation to be below 0% into deflation, because that can cause a deflationary spiral due to people delaying the purchase to later, which means that a deflationary spiral will cause a lack of aggregate demand in the economy, which will stop our growth. Now we also believe it's better to keep it at 1 to 3%, because it's extremely hard to keep the inflation rate at 0%, and it's too risky to have zero involved in the band. We also believe it's much better to keep it at a band of 1 to 3 rather than, say, 2.5%, because if it's at a specific level, we have to keep changing our policies, which means there's lots of uncertainty in the economy, and it doesn't improve investment. We also believe that there is some aspect of benefits from having a low and stable price stability, because that means that when the consumers push their wages up, this means that the disequilibrium can be fixed from inflation, and therefore we believe it's best to keep it at a bandwidth above 0%.
Okay, very good. A quick follow-up question. So currently inflation is below the target band. Do you think that's a problem?
Well, it's not a problem because it's predicted to go back up.
So it won't be a problem if it's going to stay below the band.
Yes.
But because it's going to increase, we can leave it the same.
Yeah.
Over the medium term, we'd expect it to be within the band.
And we know that any action that we will take using the ISO will be quite effective because of the high household debt.
Yeah, so basically there's 3 aspects to it. If it's below, it could keep decreasing, or stay low, or increase up.
Yeah.
Because it's not going lower and it's not staying low and it's increasing up, we can just leave the LCR the same. So do you want to summarise that? Okay, I'll summarise that. So basically, we believe that So there's a couple of circumstances of what would happen at a low inflation rate. At below the band, it could continue decreasing. It could stay at 0.9%, or it could increase back into the 1 to 3% band. And we believe that if it is projected to decrease, or if it's projected to stay below the band, we need to definitely lower the LCR to get it back in the band. But because it's projected to go back up by itself, we can leave the LCR the same, and therefore it doesn't always matter if it's below the 1 to 3 band.
Okay, thank you. Nick?
Okay. So I might change tack a little bit. I was quite impressed to see you guys discuss the spread between the OCR and market interest rates. But I just wanted to get you guys to clarify. You mentioned that if we lowered the OCR, it wouldn't necessarily be passed on to market interest rates. But when you were discussing raising the OCR, you mentioned because a lot of people are on fixed mortgages, that actually the OCR would, floating mortgages, the rise in the OCR would actually be passed through to consumers. Why is it you believe that a cut in the OCR wouldn't be passed through, but a rise would?
Okay, guys. So basically, the reason it's not going to affect it if we decrease it is because commercial banks can't lower it anymore because of the international turbulence.
Yeah.
But if we raise the OCR, the commercial banks have to raise it.
Yeah.
It doesn't matter if it's turbulence or not. So that's why it matters.
And it's also because the government's, the Reserve Bank, private banks in New Zealand's only source of money isn't the Reserve Bank. They also gain it from offshore banks. And so those interest rates also have a massive effect on the rate they lend out money.
Yeah, true.
Yep. So, the Reserve Bank's official cash rate and the rate faced by New Zealanders in the public is different because while the Reserve Bank supplies a large amount of proportion of money that is lent out to the general public, a lot of it also comes from people investing in banks and also overseas banks. And so these factors and their rates also have to be factored into the bank's lending rates. And also, if the bank likes making profit, and so if the rate goes up, it's in their best interest to move it straight away, because that increases their that would be cutting into their profits if they weren't to. But if it goes down, it's in their interest just to keep it up for a little bit, because that means they get some bigger profits over the short run, and then they can move it in 6 months or a year's time.
So basically, it wouldn't decrease commercially because they can't decrease it because they borrow internationally. But because a large amount of it is from the Reserve Bank, if the Reserve Bank increases the LCR, commercial banks have to increase their rates, and that's why it would have an impact by increasing the rates, but it won't have as much of an impact by decreasing it because commercial banks can't decrease it much because of the turbulence, and that's why it's a different circumstance for both raising and lowering.
Okay, thank you.
Back to me. Okay, so immigration has been increasing recently. So if this continues, so net migration to New Zealand, if this continues to increase, what effect might that have on the economy?
Okay. So it's going to affect the labour market, obviously.
Yeah.
I think there's two aspects to it. So it'll increase aggregate demand of the economy, but at the same time,
We could get more skilled labour as well.
Increases the supply of labour.
Yeah.
So demand and supply of labour will decrease wage prices.
so wage prices will decrease. So it's essentially,
So you'd
Yeah,
have
it should
increase in
increase.
AD, which could be inflationary,
but
but
then a
also
decrease,
decrease in
yeah,
wage
because
prices,
of
which could
wages.
bounce it out, so you don't
Yeah.
really know.
Yeah.
So do you want to summarise?
so there's basically two facets to this, to an increase in population. First of all, there will be more consumers in the economy, so therefore an increase in aggregate demand, which acts as an inflationary pressure. But on the other side, it's also an increase in the supply in the labour market, and so this creates downward pressure on wage levels, and so it sort of offsets itself in a sense because of the contrasting pressures.
Which effect do you think will be bigger? So what's the net effect?
So a bigger one would be...
I think we have to ask the question, what other people coming to
I
New
think
Zealand bring
bit
with
more-
them?
More
who's going to be the
Yeah.
people coming? Like, they're not going to be consuming that much.
Yeah. It's more likely to offset in the labour market.
Because if they're going to increase the supply, they're probably low skilled and they won't be consuming that much, and they'll be increasing the supply
Yeah.
quite a bit. So probably the decrease
Yeah.
in the wage prices could
Yeah.
be potentially
Significant.
bigger. Yeah. So we believe that it really depends on what kind of people are coming into New Zealand. So we believe that if they are increasing the supply of labour, they're most likely low skilled workers, and therefore relatively they'll be having a lower consumption compared to the Western New Zealanders. And so the increase in the supply of labour could potentially have they're bigger than the increase in AD. However, we also believe that wage decreases are really they don't like them. So we believe that although they may be a market equilibrium at a lower price, the wage prices might not actually decrease, and therefore the AD could actually increase it. So theoretically it should be the supply, but because we don't like lower wages, it's probably there a good demand increasing more.
Okay, thank you. Just looking at your slide, I can see on the concluding slide issues with two overvalued asset prices. One being the exchange rate, which presents a downside risk, I guess, for inflation, and one being house prices or the housing market, which gives an opposite risk. So there's a tension though between these two asset prices. How do you think macroprudential policy would change that tension?
Do you mind repeating that, sorry? That question?
Sure. So I'm thinking about those two asset prices, exchange rates and housing market, right? And they're working in opposite directions in terms of policy. Suppose now we introduce new macroprudential tools. How do you think that would change the tension that's currently present?
So the issue with housing prices is obviously the inflation which is occurring, and the reason why you can't just increase the OCR to deal with that is that it will create upward pressure on our exchange rate.
Yeah. So the house prices aren't core inflation, because if we try and increase the mortgage rates to cause a deflation, it'll actually increase the housing prices. That's why we don't involve in core inflation.
Yeah.
So basically, if we increase the interest rate, we'll have more money coming into investment, which
will also increase inflationary pressures.
Yeah, which would make our dollar worth more.
Yeah.
I
Okay,
don't want
so
to increase house prices.
in terms of that, macroprudential tools actually essentially act as an alternative way to decrease aggregate demand in the housing market. So recently, the Reserve Bank, I think, said there needs to be a loan-to-value ratio of at least 20%, which makes it more difficult for people to buy houses, essentially decreasing aggregate demand. And so the problem with just increasing the OCR is that it leads to an increase in our exchange rate, and so more people invest in New Zealand, and interest rate, sorry. And so that is an inflationary pressure in itself. And
Deflationary.
Deflationary pressure, yeah, sorry.
That's okay.
And so it's just another alternative to offset that high demand,
Very good. Yep.
housing market.
Thank you.
Okay. I thought it was really impressive that you guys mentioned core CPI, and I think you've actually mentioned it in one of your answers to one of your discussions to the questions as well. So my question is, what exactly is core CPI, and why is it important for monetary policy?
Okay.
So core CPI doesn't involve the fuel prices, and
Yeah.
currently
So the
doesn't
volatile,
involve the house
housing
prices.
market either.
So the reason it's called is because it's so volatile.
Yeah.
And the reason we don't want those is because we want them core.
Because you can't affect them in New Zealand because they're things that aren't the term of economics. It's like about oil prices overseas, which the Reserve Bank can't affect. And it's also like GST is was also an example of headline inflation. It wasn't core because it was policy that the government, the Reserve Bank can't affect because it's an event that's been taken somewhere else.
Yeah, true. Anything else? Do you want to summarise it?
So, core inflation is inflation pressures that are due to the economy acting in a manner that is insular, and so like things like the government increasing GST doesn't come into it, and increasing fuel prices and housing prices, because these are things that
They're very volatile.
they're very volatile and they change consistently, and so if the Reserve Bank was to change their policy, it would become very fluctuating, and the government, investors would lose consumer confidence, which would decrease aggregate demand.
Okay. Good.
When you were talking about some of our trading partners, you mentioned China's growth is slowing, but there are a couple of offsetting factors in there. If China's growth does continue to slow, what do you think the net effect on New Zealand will be?
China's growth is slowing, but at the same time, lots of their population is becoming wealthier, and so they're starting to demand more of our dairy products, our meat. And so it's sort of offsetting in that as their incomes increase, they still demand a great proportion of our agricultural products because of the shifting nature of their economy and their consumers.
Yeah. So as long as they don't start falling back beneath where they were before, we should be okay. We should be able to continue exporting.
The decreasing growth in China is probably likely to affect us less than elsewhere, because as they become wealthier, they demand more of our agricultural products, more meat products. It's just because they're more luxury goods than, say, rice or other products they ate before. And so our trade of China, which is largely based on those products, is likely not to be affected too much, even though there is a slow decrease in growth because of the wealth effect in China, which is offsetting that.
Right, so that's a direct trade effect you mentioned. Are there any other ways that a slowdown in China could affect New Zealand?
They might be less willing to invest overseas. They might be more conservative.
The money rates.
What about the LCR? They're lowering their to deal with the decrease in growth. China has lowered their LCR so they can boost the economy. So that means that relatively our LCRs more attractive, and that will cause more investment to us.
Investment in New Zealand.
And so to increase our exchange rates and affect the exports and imports we have.
Yeah, and probably also lower the interest rates because demand for world demand for money will go down. So I mean, interest rates at banks will go down because there's less demand for that money.
True. So we basically believe that apart from potentially decreasing our aggregate demand, in order to boost their Chinese economy from their slowing growth, China has decreased their lending rates, and therefore that means that relatively our lending rates in New Zealand become more attractive, and we could attract more investment, having a high demand for our dollar and increasing our exchange rates. That obviously impact our export and import ratio, which could be a deflationary pressure, and would be tough on our exporters like agricultural products.
And there's also an indirect effect with our trading partners. So because China trades with a lot of people around the world, a decreasing growth in their economy is essentially similar to, it will create decreasing growth in other countries around the world. So although that doesn't impact us directly, the effect on the other economies they trade with will indirectly affect us.
Good. So the New Zealand dollar seems to be very high at the moment. Can you explain why?
Inflationary pressures from ED.
Our exports have still been demanded by a lot of countries around the world.
New Zealand's got relatively high official cash rate, and
Yeah.
New Zealand dollar is highly speculated on because it's viewed to be stable because the government has no plans and has never really seriously suggested quantitative easing.
Yeah,
So therefore,
because-
people are like it's not going to change in the short term, so we should invest in it and speculate and make money in the long term.
Because everyone else is raising lowering their LCRs, it becomes really unstable for people to invest in them. So they invest more in us, and because our LCR is higher, so that's why exchange rates are so high.
Yeah, and at the same time, there has been a lot of demand for our products.
Yeah, true. True in some ways, too.
Thanks, Ian.
Absolutely.
Okay, so we think that the reason it's high is because relatively our official cash rate is higher than Europe and America, which means people are more willing to invest in New Zealand. I mean, and this also it also means that
We're perceived to be a lot more stable and a lot stronger in our economy. There's been less fluctuations. We've dealt with the global financial crisis a lot better than other countries. So there has been a lot of investment in New Zealand relative to elsewhere, and at the same time there has been a sustained demand for our products despite the crisis.
and because we haven't engaged or have any plans to engage in quantitative easing, the New Zealand dollar won't devalue in the short term, which means that in the long term, overseas speculators can invest in the New Zealand dollar and then buy back their own currency to make a profit. So this also pushes up the value of the New Zealand dollar.
Good. Excellent. I think we've got time for one more. So we have. Good. So you don't escape just yet.
Okay, so I'd like to ask a follow-up question just on your answer there. So you mentioned quantitative easing as one of the reasons why our exchange rate's quite high. What are some of the other effects that quantitative easing by, say, the United States would have on demand and inflation in New Zealand?
Okay. I think there's two aspects to that. Quantitative easing, although it's used to stimulate the economy, which would encourage growth and therefore buying more of our products, at the same time it's a sign of weakness in an economy. So despite the fact that it's intended to stimulate, they might actually end up decreasing the consumer confidence, and so decreasing demand for our exports and confidence.
It will also make their goods relatively cheaper for international exporters compared to New Zealand, so it may take away some of our trade because we're relatively more expensive than the United States than we were before.
Okay.
Plus, the US, although they've been doing quantitative easing, they've left a lot of it just in the bank. They haven't actually put it out into the economy, and so we don't know what they're going to be doing with
So there's
that
a lot of
money.
uncertainty associated with it
There's a lot of
because
uncertainty
we're not
with that.
entirely sure what will happen with that, the excess money that's just in the banking system.
Yeah. So what points have we got for that?
Okay. So you guys can just add on as we go. Generally, quantitative is a measure used to stimulate economic growth, and so you'd expect that to cause inflationary pressures in New Zealand. But at the same time, it's a sign of weakness in the economy, so perhaps there will be a decrease in consumer confidence because of that. Again, there's lots of uncertainty associated with it because not all of this money has actually been injected into the economy, so we're not entirely sure when they will when changes will actually be made.
And because the value quantitative easing causes the value of the US dollar to fall, that would make the US goods exports relatively cheaper compared to New Zealand exports, so that would decrease aggregate demand for New Zealand goods, which would obviously lead to a decrease in production and a decrease in price level, so it would cause
So our high exchange rate will be seen as being even higher, which isn't good.
Excellent. Okay. I think we're done. Thank you very much.
Thank you.
Hope you enjoyed the experience.